Welcome to Decoding Retirement. I'm your host, Bob Powell, and today I'm joined by a legend in the financial profession, Michael Kitces, a longtime friend. I think 2005, maybe?
Yeah, it's been almost 20 years.
20 years, Michael.
Time flies.
Yeah, it's flying. And I apologize. I missed your session here at Schwab Impact because I was doing a podcast.
It's busy.
It's very busy. But you were talking about the 5 trends that are affecting the financial advice profession industry right now.
Yes. From the financial advisor's perspective, effectively all the ways that just this ongoing evolution of technology keeps shaping and reshaping what we do as financial advisors. The sort of conventional wisdom is AI, robos, like all the different things are supposed to displace mass quantities of professionals. But when we actually look at what's happening in the advisor space, the technology has never really actually materially displaced advisors. I mean, we've been through computers, the internet, the smartphone, remote, all of it. And the advisory business is actually is an even deeper, more enriched value proposition now than it was 20, 30, 40 years ago. So the technology in practice has not displaced advisors. It's actually amplified and deepened what consumers can get from financial advisors these days, because we don't have to spend the time managing the portfolio by hand. And we have technology that increasingly automates much of the trading process, so we get to spend more time actually helping clients the full breadth of their financial needs.
Yeah, it's almost like the investment side is table stakes, commodity, and the other stuff is more important, right? The financial planning aspect is more important, the value add.
Well, yeah, I mean, to me, it's similar to realms like, you look at what's happened with travel agents. So the conventional wisdom was like Priceline, Expedia, and all the .coms came along and obliterated the travel agents. But if you actually go and look at Bureau of Labor Statistics data, a lot of travel agent jobs were lost, but travel agent productivity went up 300% after the internet came out, because they got the travel agents version of those same tools. And as a result, the travel agent industry is now twice as large today as it was 20 years ago. It ended up actually being a boon even for them. But you don't call your travel agent because you need them to book a hotel reservation and a plane ticket, which is literally what we did 30 years ago. Book those things, mail them to me. I'll get it a little envelope in my mailbox so I can bring the paper ticket with me. Now, okay, anyone can book that. I can do that online, or my travel agent can do that. My travel agent to me instead comes and says, so what would be a meaningful vacation for your family? I mean, what kind of memory do you want to create? How old are your kids? What do you want this experience to look like? So, as a parent myself, in the past few years, I started hiring a travel agent for the first time. I mean, I'm a professional speaker. I travel for a living. So I don't have trouble in how to book travel. But when I'm taking the family to Disneyland, I don't know all the stuff about how to maximize the experience at Disney given the particular ages of my kids. Yeah. So we went and worked with a travel agent to help us figure out how do we actually make this a wonderful family experience. And we paid her a fee that I was very happy to pay her. And we had a wonderful family experience and a great memory. And so I see that writ large across everything from travel agents to what we do as financial advisors, right? It's not sort of the rote implementation stuff, because a lot of us can do that with the technology. And look, as advisors, we have our own tools to do a version of the same thing. It's about what we can do to get more personalized advice to navigate through our complexities that we're dealing with. And I find similar to maybe how it shows up in a realm like health and medicine. Look, when I'm younger and relatively healthy, hopefully I go to my doctor for my annual physicals. Some of us are a little bit better about it than others. We kind of know it's good preventive care and we do the best we can, and we move along. And then when health slips and a health event happens, all of a sudden, I want a doctor that knows me, that knows my stuff. I hate explaining my medical history every single time I go see a new doctor. I want a person that knows all the things and understands my care over time and how it's evolving and what treatments for me have worked and not worked. And I find a similar phenomenon crops up in our finances. There's a point where a lot of us are pretty comfortable doing it on our own, and maybe we want an advisor, but often we don't. And then the complexity starts to get higher, and we don't have to re-explain our financial scenario every time we're dealing with someone, and we want someone that actually knows and understands our circumstances and can walk along with us over time as we deal with all the complexities that crop up. And suddenly financial advisors become much more relevant, and because of the technology that we've had, we can actually do so much more than that in the past. So 20 years ago, an advisor that was helping you for retirement, I said like, I'll help you make a diversified asset allocated portfolio. And now it's like, well, I'll help you build a portfolio. I'll do the tax sensitive Roth conversions. I'll effectively asset located across multiple domains. I'll figure out how to draw it down in a tax efficient manner. I'll also coordinate with the timing of your Social Security. I'll show you how to do health insurance between early retirement until you're eligible for Medicare. Then I'll help make sure that you make a good decision about your Medicare Part D plan. And when you're ready for a continuing care retirement community, we'll help you vet all those as well, because we do that for a living. And like those are the kinds of value propositions now that we see for firms that specialize in retirement services. And it's just so off the charts deeper than even like what I could do when I was starting 20 something years ago.
Yeah, and I think the knowledge, skill, ability required to do that is really high. But in your speech, you talked about there being a crisis of differentiation. Like, given that that's the bar,
Yes.
and that means everyone's there, or some people are here.
One of the challenges that happens, so the way we typically get trained as financial advisors is gather data about the client, spend time in discovery, understanding their goals, needs, wants, and wishes, and what's important to them. Take the information, the financial information plus the goals, and help to articulate them a prospective plan to achieve those goals. And then you bring it back to the client and say, like, did I get it right? And you shape the recommendations, and then you help them implement it. And on the one hand, like, great, that's sort of the nature of advice. Like, help me understand your situation, I'll give you the advice. But what it indirectly trains us in is, well, I can work with anyone because I know money things and how to ask clients questions. And so we historically have kind of resisted specialization, right? It's kind of like, I'm a doctor, I know about medical things. Like, I'll do your brain surgery, your heart surgery, your elbow, your knee. Like, you tell me what hurts, I'm a doctor, I'm gonna help fix it because I know a lot about medicine, I'm really good at discovery. And so yes, but from the advisor end, eventually that makes it hard to really scale and deepen your services because you can't really know everything about everyone. So it starts to get difficult to get deeper, which a lot of advisors now are feeling. And frankly, from the consumer end, like, most consumers can't tell us apart. It's really painful from a consumer end. And like, I mean, we see this writ large. The #1 Google search for financial advisors is financial advisor near me. Which to me basically says, so advisors are so hard to differentiate from, I just picked the one that's geographically convenient to my home or office. And if I take that to another realm, like, look, if you had a rare health condition and there were only a couple experts on the planet that could help you with that condition, like, I'm getting on a plane and going anywhere, and I'm gonna search on Google until I find like one of the 6 leading experts in this thing, and I'm gonna go do it because the stakes are that high. And as advisors, at least historically, we have not made it easy to sort of sort ourselves into those buckets. And so from the consumer end, like, I empathize a lot with consumers that I think really struggle to figure out how to tell us apart. How do you tell which one's good? How do you tell which one's knowledgeable? Because we don't really articulate our specializations very well. But a lot of the work that I do is with advisors as well. I'm in an advisory practice, but I also do a lot of teaching and training to advisors. And from the advisor end, a lot of the discussion is like, look, if you want to stand out in a crowded marketplace and show why you really are the best advisor for this particular segment of clients, you got to get clear on who they are and how to show up to really be the best for them. So we do a lot of work with retirees, so I know all the things that we do for retirees. Other advisors will focus other areas and find their domains as well.
Yeah. Jack Welch was famous for saying we're either going to be #1 or #2 in our business line or not in that line at all. Talk about what's going on with fees. For the longest period of time, right, clients would pay a commission, then commission and fee, then AUM, and then retainers, and maybe subscriptions, and it's a brave new world for fees.
Yeah, from the advisory end, we kind of talk about this as new fee models, or sort of the industry label is alternative fee models, which basically means anything that's not an assets under management model, which is kind of the typical, the dominant model in the advisory industry. We do some tracking on this from our Kitces research platform, and we find upwards of 90% of advisors have some kind of assets under management based model. So for folks that actually have, like, I have a sizable portfolio, I don't really want to be responsible for it. This is my whole nest egg. If I make a particular retirement, like, if I make a mistake at this point, like, I don't get a second chance. I'm not going back to work at this point. So I really need someone who can be an effective steward. And that assets under management model actually works very well in that domain. But not everybody actually has a want or need to hand over their portfolio and say, manage all the money things. Sometimes, like, well, I have questions. I want to come to you and validate I'm on a good track. Or you know what, like I'm comfortable with the investment stuff. Like I can buy Vanguard funds and do the thing. I need help with the Social Security and Medicare and the tax sensitive withdrawals and the Roth conversion. Like I got a long list of other things, but investments didn't happen to be on my list, in which case assets under management is kind of weird because I wasn't looking for the under management part. So a lot of the growth now that we're seeing in alternative fee models are advisors. They're just willing to not do investment management as a primary service, a core service, or even at all. There's now a segment of advisors out there that are known as advice-only advisors, which means I cannot and will not manage your portfolio. Like it's not even I'm going to say I'm going to do a plan for you for a fee, but then I'm going to kind of pitch you on the assets at the end. It's like I'm literally categorically unable to manage your portfolio. So like I am only here to give you advice. And for mine, it just means the advisor landscape is trying to broaden the fee models that we have to serve a wider range of consumers. You know, there's been a pretty long run for the past 20 years towards the assets under management model, and it works well for consumers. I mean, we can see it. Retention rates of advisory firms that do it is sky high. So clients are happy. Advisory firms are able to scale and reinvest. So it has worked well for all. But there's literally only so many people that have like a significant portfolio of assets and want to hand them to another advisor to do it. And so to me, a lot of what we're seeing now in this sort of alternative fee models trend, we see it with monthly subscription fees, retainer fee models, net worth and income-based models, flat fee models, is all built around, there's actually a lot of consumers out there that want to find other models and other ways to engage and have struggled historically. And now that's starting to open up. So you can find advice-only advisors. We do a version of this at XY Planning Network for our Find an Advisor platform as well. Just trying to create more ways for consumers to find non-AUM advisors for all those that weren't looking for someone to do the portfolio management, but they need help with a long list of other financial advice areas.
So we only have like a minute left, Michael. I was thinking that I've always thought that there was a need for financial health insurance, much like health insurance, where I could pay a fee and then have access to an advisor, sort of like what occurs with legal services at your employee benefit.
Yeah, there are a few. I can tell you there are a few firms now starting to experiment with that. Primarily in the same place that you find prepaid legal, which is like in employer channels as kind of an employee wellness, a financial wellness offering to say, look, for a truly modest fee across all of the employees of the firm, we can staff a full-time CFP who will be available for 30-minute or 60-minute blocks to answer this very real-time point of pain financial advice questions that someone may have. It's not a big broad-based scope of engagement, and similar to prepaid legal, if I actually had to hire a lawyer for a couple of hours, this gets really expensive really quickly. If I pay the fee with everybody else, some of us pay the prepaid legal fee and then we never use the lawyer, and it's technically lost money. But that means if I do need the lawyer, I don't have to pay hundreds or $1,000 or $2,000 to do the thing, because I've essentially participated in a prepaid legal insurance combination sort of fund that the people who don't utilize help to support the ones that do. So there are some firms starting to experiment with that in the financial advisor spaces as well, under, again, our industry label, our financial wellness benefits. But I'm excited to see that growing. To me, it really expands advice into a broad swath of consumers that, candidly, I don't think our industry has served very well historically. They need advice. We have people who want to give advice, but we couldn't figure out how to match those together in a way that firms can scale and sustain. And some of these new emerging financial wellness models, I think, start to open that door.
Yeah. Michael, I know you have to catch a plane.
Yes,
we've run out of time. I want to thank you
Absolutely,
ever so
my pleasure.
much for sharing your knowledge and wisdom with us. It's
my pleasure.
Appreciate it. Thank
you.
And we'll be right back with more of Decoding Retirement. Welcome back to Decoding Retirement. We're speaking now with Reeya Patel. She's a senior at University of Florida, and soon to get hopefully her CFP certification. So,
yes.
Reeya, welcome.
Thank you for having me. This is
pleasure.
awesome. Thank you so much.
So I'm eager to learn about what you learned in the CFP program at the University of Florida.
So much. So the core courses are the CFP approved courses that you take. And so what I've learned so far is currently I'm in risk and insurance management, the capstone class, and then I've done estate and tax planning as well. So I've learned a lot about that field. I'm ready to use it into play kind of in the real world, but a lot of like the bookend stuff of how everything kind of works, the basics, building it down, and then kind of diving deeper into some aspects of like insurance and estate planning.
Right. So you've already taken income tax, retirement,
yes,
basic financial planning,
and then I'm in the capstone right now. So we develop a financial plan. So I just finished mine. So hopefully it gets a good grade.
All right. So as someone who's going through this program, what have you been able to apply to your personal life? And then what advice would you have for people who are either college graduates or soon to be college graduates?
Yeah, so I think especially in the first class that we take, we bring a lot of industry professionals. So one of the things that is not in the book that I've like really mastered or starting to master is like my communication skills and my confidence. I feel like it's grown tremendously throughout this entire program. And then advice, as for students who are younger than me or older than me or going through this program, anyone, I think that having a good, again, communication skills and having good emotional intelligence is really important, I think, in this industry. So that would be my advice. Network as much as you can. Even in being an impact here in this conference, I've met so many people who I've seen before and would come to UF and spoken and like who have been mentors to me. So I've re-met and they've introduced me to more people. So it's like a snowball effect. So once you start meeting people, I think you are golden.
Yeah, I think one of the best pieces of advice I've given to young people, including my own children, is to network.
Yes.
So really important.
Oh my gosh.
So what about on the money side? Like a lot of folks think, okay, I'm going to go enter the workforce. I'm going to have income for the first time. I'll have expenses. Where do you start?
Where do you start? So what I've done throughout college is, actually my dad has inspired me to do this, is to create a whole expense sheet and income sheet. So like just tracking my expenses, how much I spend monthly, and also credit score is also super important. So opening up a credit card when you're in college, using it, make sure you're paying it off monthly, twice a month. That's what I do because I'm a fanatic and I get panicked. But
Do you know your credit score?
no, I think it's 7 something. I don't know what it's high. I know that it's high because I don't let it go down. But obviously I'm still new. I haven't held it for like that long yet, so it's not gonna give it that reach that is there. But
so when you enter the workforce, you'll be fully prepared to save for retirement?
oh no. So what I've been doing also is investing because I have a job on the side. So I take $250 a month and invest it into an ETF. So it's just going automatically, plugging every month. So compounding is a big thing. So hopefully by the time I retire, I can raise that number every time. When I get a job in the future, I'll raise that number every month. And hopefully by the time I retire, I can have something tangible to retire with.
And then in terms of, so that's one goal.
Right. Yeah.
I mean, we often have to save for multiple goals, right? Buying a house or saving for a wedding or saving for second home, all that stuff.
Yes. So with that, I don't know, I'm still small and I feel like I haven't thought about that stuff yet. I think once I get a job, seeing how I will start building financial plans for people who want to save for houses, people who want to save for college educations. I want to open up a 529 plan. So I know that there's these resources out there. I haven't used them yet just because I'm so young and can't yet. So
that's fair.
But yeah, that's the...
So when I think about my children are in their 20s, they're out of college. And when I think about where they go to get financial information and advice, oftentimes they say it's TikTok or Instagram or YouTube. What's your thought on your generation's use of social media for financial advice?
Yeah, so I think if you can try and tailor your algorithm that way, that's great. But there's also a lot of like biases out there. So finding the right resources is great. I listen to a lot of podcasts.
Who's your favorite? I
like Morning Brew a lot. I listen to them every morning. They give me the big rundown. And then Wall Street Breakfast is also really good. They also Yahoo Finance. Great for doing a little plug-in. Yeah, just doing a little plug-in.
Take that.
But yes, in the mornings, that's what I listen to is Morning Brew and Wall Street Breakfast. But and then they also have Instagram. So following them, they always post like updates. Anything big that happens, you'll get it to your Instagram feed immediately, so you get to read it. Yeah. But just make sure you know who you're following and what resources you're getting.
All right, so you've read in your program a lot of boring textbooks, I know, because I've gone through the CFP program.
Yes,
but are there some sort of general business books that you might recommend that young people read?
Yes, so one of them that was my absolute favorite, I discovered it when I was studying abroad in London. In Amsterdam, I was taking a little tour, and I read it on the plane back. It's called Girls Who Invest. Awesome book. you don't have to be a female to read it. You can be of any kind. And that book starts from the basics of investing, and it tells it in stories. So it's not something, like it doesn't throw graphs and charts at you. It starts from the beginning, and it kind of explains it in stories of how she started investing, how her parents started investing. I think it's a great book. And then Psychology of Money.
Right.
Super basic one,
Morgan
but
Counsel,
yes,
yeah.
awesome book. Those are the first two that come to my mind.
Yeah. What'd you learn, take away from Psychology of Money? I gave that book to my children as a Christmas gift.
Yes. I think just the way how behavioral finance plays into everything. I think being irrational is a big thing in this industry. Like, that's how clients kind of get scared. So taking a step back, I think learning from that book on how to take the emotion out of it when you're investing, and learning about the cycles and how money works.
Yeah.
The behavioral side was a big thing that I kind of took away from it.
Yeah.
But yeah, great book.
So when I think about behavioral biases, there are things like loss aversion or recency bias or overconfidence.
Right.
Do you have some biases that you think your generation needs to know about?
Oh, I think overconfidence is a big one. I know a lot of us, when they see a stock go up, they're like, oh, we gotta invest in it.
It's all because of what I...
Yeah,
right.
So, that's a big one. I also think that recency bias is also huge. Like GameStop happened, and I was in high school when this happened. And so there's a lot of buzz in high school. And where I'm from is a small town, so a lot of people, like, I didn't realize like how many people follow the markets as much, but they were all like, let's put it in, let's put it in, let's put it in. And I was like, guys, I know it's big right now, but you never know. And, kind of look at it now.
So it's interesting, in a world where we live, where there's so much sports gambling, a lot of times I think equate investing to gambling, like GameStop.
Exactly, yeah.
So they're not necessarily investing, they're speculating.
No, exactly.
So what advice do you have for someone who's sort of like mixing up the two things?
Oh, I would say take it apart, kind of. Go to the root of it. I think gambling, I feel like one of them is like you're actually gambling, and the other one's like you're investing in your future, if you do it the right way. So I think taking a step back and realizing like this is like investing is long term, and gambling is like very instant gratification. And I think that's another problem that I think our generation has, and I think everyone has, is like instant gratification. So delaying that, I think.
All right.
My best advice.
All right, Reeya, we've run out of time. I can't thank you enough for
so much.
being here and sharing, with our listeners and viewers your experience. So thank you.
Thank you for having me. I really appreciate you.
And now it's time for a segment that we call Ask Bob, where we answer a reader question. So the reader's question goes like this: should I trust AI for personal finance information? And the answer is this. AI is ultimately unreliable as a source of information for personal finance. It gets some stuff right, it gets some stuff wrong, and then there are some serious material omissions. And so when in doubt, check with a subject matter expert rather than an AI bot. If you've got questions about money or retirement, I'm here to help. You can email me at askbob@yahooinc.com, and we'll answer your question in a future episode. So that wraps it up for this week's episode of Decoding Retirement. We hope we provided you with some actionable advice to help you plan for or live in retirement. And don't forget to check out Yahoo Finance for more information about retirement news.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.